We begin, though, of course, with the market as the major averages sit within striking distance of record highs. Our first guests have very different outlooks on where stocks are headed in the next few months. And joining me now are Ryan Detrick from Carson Group and Eric Johnston from Cantor Fitzgerald. I mean, welcome, guys. Gloves on in a way. But just to set things up, Ryan, stocks are expensive on a valuation basis, but you say the bull market is still young. So which outweighs in your mind?
Yeah, John, thanks for having me, and happy GameStop day, everybody out there, right? Listen, there's a lot of ways to look at this, but this bull market's 19 months old, right? Up over 40% since October, just recently when we had the bull market start October 22. And you think about it, the average bull market lasts about 5 years. I get it. Every time is different, yes. But look at what we just saw last week. New highs on advanced decline lines on the S&P 500, on the NYSE, and on mid caps, and almost 52-week highs on advanced decline lines of small caps. What is that telling us? What's the message of the market? There is a lot of participation, John, under the surface. It's not just 4 stocks, not just 7 stocks, whatever we call it. There are a lot of stocks participating. And one final comment here, historically, you tend to get a summer rally in an election year, and I get it, every time's different, but we really think that flush out we had, the 5.5% pullback, minor pullback we had last month, was enough, and now we're back to the bull market, and things still look good to us.
All right. Now, Eric, you were bearish about a year ago. Then you got tactical, said it's a tactical trading market. Now it sounds like you're turning bearish again. You're not looking for a summer rally, right?
I'm not. So, I would say that we are, one of the backdrops of this overall market is that we are late cycle. This is the longest period we've been below a 4% unemployment rate ever. This is the longest period of time we've had consecutive 100,000 plus jobs reports ever. And so we are late cycle. And what's happening now is that the economic data is clearly decelerating as we speak. And so some people are arguing that it could be short-lived, which it may be. But I think the market is not pricing in a high enough risk that this is the beginning of a larger deceleration. The labor market, as an example, while very strong, is clearly decelerating. The job openings decline or hit a new cycle low. The new hires print on that same report also hit a new cycle low. And then you saw a payroll report most recently where if you take out healthcare and education, the cyclical part of the economy, jobs were below 100,000. And then within the services sector, which has clearly been the backbone of this economic strength, ISM services employment was the second lowest print ex-COVID in 10 years. The ISM services new orders, second lowest in 10 years ex-COVID. So, and then we're seeing it from corporates too. So there's clearly a slowdown going on right now. And I think the market is just not giving a high enough probability that this could be the beginning of something larger in terms of the deceleration.